What is a fund? Most Americans don't buy particular stocks or particular bonds. Instead, most Americans use investment funds as a way of making their investments. And generally speaking, funds are an investment for all seasons and for all investors. You're going to have to try harder to put the fun back in funds. How about putting the fundamental into funds? This is a very important instrument. Most of the Fortune 1000 companies, 75% of their securities are held not by particular investors, but rather held through intermediated group funds. So if everybody already uses them, what more do we need to know? Investment funds are a little bit like cars. They're awfully powerful tools that have the ability to do enormous amounts of good, but they can also do a little bit of harm if they're not used properly. If we can look under the hood and examine their structure a little bit more closely, we can try to get all the benefits from funds while avoiding some of the harms. What do you mean structure? Don't you just buy these things from the companies that sell them? Fidelity and Vanguard will hook you up, yo. Many people think that funds are just another species of financial products, like CDs or annuities. But actually, they're quite different. CDs, dude, try MP3s. Certificates of deposit, friend. Of course. Anyway, we were talking about funds. An investment fund is actually its own distinct legal entity. It's known as a collective investment vehicle. We're back on your vehicular analogy? Sounds like a Yugo. A vehicle is simply what macho financial types call a company that has a particular purpose. So what's our purpose here? The purpose of an investment vehicle is simply to gather a bunch of different investments from a lot of different investors and to use the combined assets to build a portfolio of securities. Man, hell is other people. Why would you get together in an investment club when you could just buy and sell investments on your own? That's a very good question. We're going to have to find some reasons why the collective benefits of investing through funds outweigh the specific costs of dealing with intermediaries and other people. So get looking. You're the one who led us down this path. Here are three: professional management, instant diversification, and easy redemptions. That was quick. First, let's start with professional management. An investment fund will almost always contract with a particular company called an investment advisor to provide investment advice. Whereas you spend your time sitting around playing video games 24/7 and scratching yourself, an investment advisor has specific training and expertise in managing investments, and they provide those skills to investment funds. Very charitable of them. No, an investment advisor almost always charges for its services. In a large public fund, the fund will usually pay a percentage of the assets it has under management for the investment advice. In the smaller private funds, like hedge funds and private equity funds, the advisors will charge a combination of both assets under management and a performance fee, typically known as 2 and 20. 2% of the assets under management plus 20% of any profits that the investment advisor makes. How do you figure out the fees? With investment funds, the key equation you need to know is the net asset value, the NAV. And this is particularly true for mutual funds. The NAV is calculated by adding up all the assets, and that might include the portfolio securities, minus any of the liabilities, and that might include advisor fees, plus cash. When you have that figure, you can divide it by the number of shares outstanding in the fund to figure out a price per share. What are these different public and private things? Although the structure of most investment funds is the same, the kinds of investors and the kind of investments they make really differs quite dramatically. With private funds like hedge funds or private equity funds or venture capital funds, the investors are typically high net worth individuals who have a fair amount of money, or large institutions which also have a fair amount of money. And the investments that they actually make are generally higher risk. They might be in exotic securities, or they might be long-term investments in particular companies that require particular management expertise. In the larger public funds, again, the investors are different. They're more like you and me, general average people, or other institutions that want to invest in them. And the kinds of investments they make are more plain vanilla kinds of investments. They might just be particular stocks or bonds. They might just track an index like the S&P 500. But they're generally more simple all around. Cool, I'll take the private one. I'm not sure they'll take you. In any event, you'd have to be prepared to lose. Private funds have a much higher risk and reward profile than the public funds. Why would I want to be in one of those lameoid public ones? We still have 2 of our 3 reasons left. The first reason, again, was professional management. The second reason is instant diversification, and the third one is easy redemptions. Diversification is cool. Some of my best friends are Dollars. No, we mean financial diversification. Portfolio theory suggests that individuals should invest in a wide and diverse array of particular stocks and bonds, not just in the stocks and bonds of a few companies, because if those companies do poorly, you might lose everything. Here's the problem. It can be very expensive to build up a diverse portfolio. If you think that the stock of one company might cost hundreds of dollars for a share, somebody who doesn't have very much money might not be able to build a diverse portfolio. But by putting their money into a common investment vehicle like a mutual fund, their assets plus assets of many other investors can be combined, and the fund itself can buy the stocks of hundreds and hundreds, perhaps thousands of different issuers, providing each of the investors in the fund with instant diversification. Cool, like ordering the buffet instead of a la carte. Sure, or like betting that the entire economy will improve rather than attempting to buy and choose particular winners and losers. I prefer my analogy. And then there's the redemption. Love redemption. Shawshank in particular. Could you believe Tim Robbins dug that tunnel? Ooh, spoiler alert. This one's a little different. Redemption in funds simply means the ability to sell your investment in the funds. Don't you always have the ability to sell investments? Well, actually, not always easily. Think about one of the most common investments in our economy, real estate. Very hard to sell a house in one day. Or ever, these days. With a fund, investors are often able to sell their shares very quickly, something that might be really difficult to do with other kinds of investments, like real estate, or difficult to do if the particular investor held hundreds of different stocks and bonds themselves. Professional management, instant diversification, easy redemption. What's not to like? Here are two things to be wary of: fees and conflicts. Well, whoever likes fees? True. But the fees for investment funds often appear very, very small. In fact, they're denominated in something called basis points. A basis point is simply 1% of 1%. And again, that seems like a very, very small amount. But it may not be a small amount when you apply a number of basis points to a large investment that's been held for decades and decades and decades. In fact, a lot of people, a lot of average investors, have a very difficult time appreciating the amount of drag that increased fees will put on their investments. So over decades, people can lose a fair amount by not being sensitive to the fees that they charge for their investment funds. Plus, there are a lot of additional fees besides management fees. There might be fees for distribution, called 12b-1 fees. There might be fees called loads when you buy and sell your mutual fund shares. And of course, there might be administrative fees or other fees packed in as well. In addition, some of these fees might be waived temporarily, or they might break as the size of the fund goes larger. That might sound like a good thing, but what it really means for some people is that it's just very confusing to figure out what fees you might be paying at a particular moment in time. Other problems? Remember, an investment advisor wants to maximize its own profits. Sometimes that means increasing the size of the investment fund, which helps both investors and the advisor, but not always. If the fund grows larger, the investment advisor will make more money. And one way of increasing the size of the fund is by getting good investment returns and wise investment decisions. Another way is simply inviting more people to the party. And that way doesn't really help existing investors. So it's always worth bearing in mind that there are conflicts between what the advisor wants and what the shareholders wants. And it requires constant vigilance. Constant what?